1040s, you want to keep your money in your pocket. Whether you're a self-preparer or you pay somebody to prepare your tax return, what should you be looking for? Welcome back. I'm Jerry Masisak. I'm part of the W.A. Smith team. I'm the tax guy. In this video, I'm going to dissect the 1040 with you, line by line, tell you what you maybe should be looking for, what you can improve on. So let's get into it. All right, so here we are. We have a Mr. Smith, and if this looks like anybody out there, it's purely coincidental, but he's 62 years old. He's single. I'm looking at this from a really high level to start with here. So this is kind of a nice summary page. Sources of income. I could see that he actually is a standard deduction filer versus an itemized deduction filer. That's because standard's higher. And also I want everybody to keep in mind, he gives $3,500 to charity. So let's just keep that in mind when I start going through the return line by line. There might be some opportunity there. As we scale down, 12% is his tax bracket. Super important. In a low tax bracket, in my history of preparing taxes, probably as low as it's ever been. So that could create some opportunities. All right, so high level, I know what I'm dealing with right now. Now we're going to get into the details. All right, so here's Mr. Smith's 1040. I could see that he's got $15,000 in wages. Things that I would be thinking about here are keeping in mind the 12% bracket is, does he have any kind of tax deferral opportunity through a retirement plan for work? Is it on the Roth side? Is it on the traditional side of things? Again, 12% bracket, the Roth might have a little bit more power. He's 62. He's under 65, which means he's eligible for an HSA. Does his employer provide one? What kind of health insurance plan does he have? Okay, so those are the types of things I'm looking at on the wage side. As we scale down the tax return, there's interest income, and there's just not a whole lot you can do. You can maybe be a little bit more efficient there, but interest income is going to be taxed at whatever your tax rate is, your ordinary tax rate. The next line is dividends. So we've got two different types of dividends: ordinary dividends, qualified dividends. Ordinary dividends, I should say qualified dividends are part of your ordinary dividends. What's the significance? The significance is qualified dividends are taxed at the long-term capital gain rate. And when you're in the 12% bracket, that's actually 0%. So when I'm looking at this, I'll say, hey, you know what? We might have some room here to maybe be a little bit more tax efficient with Mr. Smith's investment. And quite honestly, that's where the holistic, comprehensive opportunity exists, where everybody's on the same page, making sure that we're as tax efficient as we can possibly be. As a side note, you don't let the tax tail wag the financial dog. So there could be an investment reason why this is happening. But again, I'm looking at this through the lenses of a tax return and tax efficiency. Next item is, and really line 4B and line 5B, those are your qualified type plans, pension plans, annuities, IRAs. Mr. Smith has a $12,000 distribution from an IRA, or could be a Roth conversion. Being in his bracket, this is the type of bracket that I would look at and say, hey, this is almost a no-brainer to be converting qualified money to Roth money if that's what's happening here. We'd have to dig a little bit deeper, and if that's something that you'd like me to cover, drop that in the comments. I'd be happy to do another video on that. It gets into a little bit more of the weeds, and it gets a little bit more complicated in terms of hows and the whens and the whys. I can also see that he's also getting Social Security benefits. So he's 62, he's eligible. Important to understand, Social Security benefits have a taxability. So as much as 85% of your Social Security benefits can be taxable. So important to remember that, because then that also comes into play with Roth conversions. All right, so as we continue down the tax return, line 7, capital gains or capital losses, and this comes through on a Schedule D. So give me a second here and I'm going to pull the Schedule D up. Schedule D, there's really 3 or 4 pieces of this that are super important. Part 1 is your short-term capital gains. Significance of this is taxed at your ordinary tax rate. So what's happening here, you're getting taxed on it at your ordinary tax rate. Short-term, held less than a year. You also have capital losses, which we would look at and see, do we have any losses that are getting carried forward from a prior year? In this situation, we do not. Long-term capital gains. A lot of power with long-term capital gains because they're taxed at the long-term capital gain rate, which is 0% for Mr. Smith since he's in the 12% bracket, but it could be 15%, 20%, as well, depending on where your taxable income falls in. So there could be some efficiency that you'd be looking at. In this situation for Mr. Smith, it's a loss, but he's also got this nasty thing down here that is called capital gain distributions. And I really want to focus in on that. These are from a mutual fund. You don't control them. The mutual fund manager controls them. We don't find out about these until the end of the year. There are strategies to reduce or eliminate this type of income. And in this situation, it probably is irrelevant because Mr. Smith's in the 12% bracket, but somebody that's outside of that, this could be a significant tax to that individual. So this is something that we really work with clients on and figuring out how we can make their portfolio a little bit more tax efficient. All right, I'm gonna go back to the 1040 and we'll start looking at that again. All right, so next line item, line 8, other income from Schedule 1. When I see something on line 8, I usually will tell myself, hey, there could be some opportunity here because there's some complication. And again, this is another one, when I start covering these concepts and these things, if you want more information, another video, drop it in the comments for me. Be happy to help you out there. So I'm going to go to Schedule 1 right now, and we're going to dissect what this $21,000 is made up of because it's going to be multiple things. All right, Schedule 1. So we can see that this Mr. Smith gentleman has business income on a Schedule C of $20,000. He has rental income, or he's involved in some sort of a business that's generating another $1,000 worth of income. Those are the 2 main lines that I normally see on a 1040. Could be other ones. If you want to know about some of the other lines, again, let me know. Drop it in the comments. Be happy to cover those. But in this situation, we're looking at Schedule C and Schedule E. Schedule C. So I can see Mr. Smith actually does have an LLC set up. He is a solo LLC owner, single member, which means by default, he is a sole proprietor, taxed through the Schedule C on a 1040. Now, is this the most appropriate way for him to be taxed? Don't know, depends on circumstances, but I will tell you there's significant opportunity by making certain tax elections that could reduce, eliminate certain types of taxes related to this Schedule C. I can also see he didn't take the time to maybe look and see, hey, am I paying somebody to prepare my taxes? That's a deduction. Hey, am I working out of my house? That's a deduction. Am I driving my car around? That's a potential deduction. Do I have to pay city or state taxes? That's a potential deduction. So without going through all of these line items, and maybe he didn't know, or maybe the tax preparer didn't take the time to ask the questions, super important. There's a lot of opportunity here, and this would be one where I would say, hey, you know what? Look for an upcoming video on maybe the opportunities and the options related to this Schedule C. Next up, Schedule E. Schedule E is our rental schedule, or that's page 1, or page 2, which is the business ownership, where you get a K-1 through a flow-through business. Well, I can tell that he has a rental property someplace. He generates $6,000 in rent. He nets out $1,000. Again, when I look at this, I say, okay, obvious deductions, insurance and interest and taxes, depreciation. Is he checking on the rental property? There's no auto, there's no travel expense on here at all. Is he paying somebody to clean the house, fix the house, do repairs on the house? So paying somebody to prepare his taxes. Again, opportunity here. And again, if there's something a little bit more you want to talk about with this or have questions on, drop it in the comments. I'd be happy to help you with it. All right, so that takes care of the other income that we're dealing with. As you can see, a lot of opportunity here with these forms, and if you don't take your time, you're going to cost yourself some tax dollars. All right, back to the 1040. As we're going down this line by line, you're going to see adjusted gross income, or total income, and then adjusted gross income. So adjusted gross income has some importance in that at age 63, there's an IRMA. And if you don't know what IRMA is, it's your income-related monthly adjustment amount related to your Medicare premiums. If you're not careful and you start doing things and creating all kinds of income for yourself, you could push yourself into a spot where you actually go over what we call the IRMA cliff, and you cost yourself some Medicare premiums that won't show up on your tax return, but they're generated by your your adjusted gross income. Okay, so important when we're looking at that. Again, I can see we're using the standard deduction. That standard deduction, when we went back and I said, hey, pay attention, that $3,500 in charity, hey, maybe there's better ways to contribute to these charitable organizations. Maybe there's a way that we can bunch a bunch of our itemized deductions together, and maybe one year we do an itemized deduction and the next year we do a standard deduction. If somebody's 70 and a half, they can do QCDs. So that's in essence where they will reduce their IRA amount by the direct charitable contribution from their IRA. So there are strategies where you might be able to use that charity more to your advantage than what's happening right now. If you're charitable, there's options for donor-advised funds also. That could work into a situation where you're bunching your deductions all into one year. And if you want to know what a donor-advised fund is and how that could work, drop it in the comments. Again, it's a little bit more complicated, more than what we want to cover here in this video. As we work down here, qualified business income deduction, that's roughly a 20% deduction off of your Schedule C or flow-through income. That then gets us to our taxable income right there, which lets us know what bracket that we are in. Mr. Smith, 12% bracket. Again, to me, a lot of power. We have 0% taxes on our long-term capital gains, okay? And we have opportunity maybe for some conversion here because we still have a little bit of room in that 12% bracket. All right, so hopefully that post-op dissection of a 1040 helped you in some way. And I think you can see no matter what bracket you're in, the types of income that you have, there's opportunity in there to save some tax dollars. If you haven't subscribed, subscribe to the channel. If you like the video, hit the thumbs up. And just as important, hit the notification button so that you know when the next video comes up for you. Thanks so much for watching. We'll see you next time.